All right, let's jump right in. Sometimes the biggest economic stories aren't in the big splashy headlines. They're hidden, tucked away inside a single, quiet number. Today, we're going to put on our detective hats and unpack the silent signals hiding inside one country's inflation data. We're going to see what it's really telling us about where it's headed. So here it is. The number we're investigating is 3.55%. That's the year-on-year inflation for January 2026. And, at first glance, what do you think? It seems pretty good, right? It's not skyrocketing, it's not creating a panic. On paper, that looks like stability. But here's where the real investigation starts. What if that calm-looking number is actually just a mirage, hiding a whole lot of turbulence just beneath the surface? This gets especially interesting when you find out this nation has set a wildly ambitious goal for itself, 8% economic growth. All of a sudden, a simple number like this starts to look a lot more complicated. And this is exactly why. To really get the health of an economy, you can't just look at the final number. You've got to crack it open and see what it's actually made of. Think of it like a meal. Sure, the total calories matter, but it's what's inside, the protein, the sugar, the fat, that tells you if it's actually good for you. And with a massive 8% growth target, the stakes just couldn't be higher. That is a huge economic leap. So the real question becomes, is this particular flavor of inflation the kind of rocket fuel needed for that launch? Or is it actually the anchor that's weighing the whole thing down? Okay, so first things first in our investigation, we need to find the main culprit. If prices are going up by 3.55%, we have to figure out which prices are rising and, more importantly, why. This is our first and most important clue. In any inflation mystery, there are usually two main suspects. First, you've got demand pull. This is the good kind, usually. It happens when people are feeling confident, they're spending money, demand is high, and the economy is running hot. It's exactly what you'd want to see if you're aiming for 8% growth. And then there's cost push. This is the painful kind, where it just costs more to make and transport things, forcing businesses to raise their prices. That squeezes everybody. So which one is our culprit? And boom, here's our first major breakthrough. It turns out a whopping 42% of this inflation is coming from one specific area, government-regulated prices, mostly energy. I mean, just think about that. Out of the total 3.55% increase, rising electricity prices alone account for 1.49% of it. This is not the sign of a booming consumer market. This is a massive signal that costs are going up. And when you really zoom in, the numbers are just wow. The cost of electricity and fuel for homes jumped over 30% in just 1 year. That's not a gentle price increase. That's a massive shock to household budgets. Our first clue points overwhelmingly to cost-push inflation. People aren't paying more because they're enthusiastically buying more stuff. They're paying more because basic necessities, like keeping the lights on, have gotten way more expensive.
Okay, so if the cost side of things is on fire, what about the other side of the coin? For that huge 8% growth target, you absolutely need a powerful demand engine. So let's move on to our next set of clues and see if we can find it.
To figure this out, economists use this really useful tool called core inflation. What it does is it measures domestic demand by taking out the really volatile stuff, like food and energy prices, that can swing all over the place. And what it reveals here is a massive gap. Core inflation is sitting at just 2.45%, way, way below that headline number. And that low number tells us pretty much everything we need to know. It's a clear signal that the domestic economic engine isn't revving up. It's just idling. Consumers are not on a big spending spree that would be pushing prices up across the board. The demand we so desperately need for that 8% growth, it just isn't there yet. And the evidence just keeps piling up. There are other silent signals that totally back this up. In a really booming economy, transportation costs would be rising as more people and more goods are moving around. But here, it's almost totally flat, at just 0.58%. Same story for food. Inflation there is a tiny 1.19%. If people were feeling prosperous, these numbers would be much higher. Instead, these quiet sectors are sending a really loud message. Demand is weak. All right, let's move to our third clue, and this one might be the most fascinating of all because it takes us out of pure economics and into public psychology. Sometimes what people are actually choosing to buy tells you way more about their confidence than any survey ever could. So, tucked away deep inside the data is this monster number, a 15.22% price jump in something called the personal care and other services category. I mean, that's a huge outlier. So what in the world is going on here? Is everyone suddenly spending a fortune on spa days? Well, no. The real story is much more revealing. It turns out the main thing driving that 15% spike was gold jewelry. And gold is a powerful psychological indicator. People don't flock to gold when they're feeling confident and excited to invest in new businesses. They buy gold when they're feeling uncertain about the future, when they want a safe place to store their wealth. This isn't a signal of economic confidence. It's a signal of widespread caution. Okay, so let's put it all together. Let's assemble all of our clues. We've uncovered high costs, we found weak demand, and we've seen evidence of public caution. So what does this all add up to? Well, the final picture is a real paradox. This table lays out this central conflict perfectly. To hit that 8% growth target, the economy needs stable and predictable energy costs. But what does it have? High and rising costs. It needs strong, broad consumer demand. But what does it have? Weak and cautious spending. It needs a confident, risk-taking investment climate. But what do we see? People are hedging their bets and hiding out in gold. Essentially, the economy is getting all of the pain of high costs, with none of the gain of high demand. So what's our final verdict on that 3.55% number we started with? Well, while it looks stable on the surface, the foundation underneath is actually pretty fragile. It is simply not the kind of economic environment that can support the incredible weight of an 8% growth ambition. And that really leaves us with this powerful thought from the source of this whole analysis. The loud, shouting number was 3.55%, and it seemed fine. But it was the quiet whispers, coming from the energy costs, the weak core inflation, the gold purchases, that told the real and, frankly, the far more dangerous story. So the next time you see a big headline number, always remember to ask yourself, what is it whispering?